Welcome to Killik & Co.'s podcast for August the 5th. Last week, equity markets continued their strong rise. We saw gains in the UK of around 1.4%. They were slightly higher going into the Non-Farm Payroll report, the jobs data that comes out in the US. That meant that the UK gave back around 0.5%, but still closing up quite strongly on the week. And we're seeing some good gains, particularly in the FTSE 250, and we'll take a look at a chart at the FTSE 250, which is well into all-time high territory and not more reflecting what we're seeing in the US at the moment. So a quick look at the diary for the week ahead. Monday, the focus has been on what we refer to as the PMI data, and we have seen the UK services PMI data out, and the number was very strong indeed. Forecasts of around 56 on the index actually came in at 60, which is the highest number that has been seen on record since these records began, which was in 1998. So certainly confidence is bubbling in the UK services sector, and my suspicion is this is going to lead through, on the back of strong construction data, to better Q3 numbers for overall GDP. So the recovery in the UK looks well underway. Again, we'll look at a chart on the currency which is reflective of this positive view that we have at the moment on the UK economy. Just turning to some of the results this week, we are obviously quite the long way through the Q2 reporting season, particularly in the US, but also in the UK. Last week was a strong week for the UK. This week we will be focusing particularly on Intercontinental Hotels. That is a stock that we cover in some depth, and we'll be publishing some thoughts on the back of those results due tomorrow. Also Esure due out this week. Wednesday will be interesting, particularly because this is on the 7th of August. This is Mark Carney's first quarterly inflation report. So we'll look at the format, how he wants to change things from his predecessor. We'll be looking at the forward guidance and how that is going to manifest itself in terms of the publication and the presentation that he's putting forward. But clearly this PMI data we've seen today does beg the question as to whether QE needs to be, and indeed forward guidance needs to be, as strong as it currently is being portrayed. So and on Thursday we'll look at some half-one results from Rio Tinto. Again, particularly interested in the mining sector at the moment. It has been the wild card for the first half of 2013. The sector has been under some pressure, particularly on a relative basis, but also an absolute basis, with commodity pricing coming easier as the China growth story has been transformed into a domestic demand economy and away from infrastructure. It has meant that commodities have been under pressure, but more so the stocks themselves. We've seen the stocks of Rio Tinto and Billiton heading lower during the first course this year, down by 20% at one point. But just in the last 2, 3, 4 weeks, we have been observing this relative strength coming back into the sector at the moment. It has been the undervalued sector and some money coming back into it. So just may help the FTSE 100 continue its current momentum, whilst other markets may well find the progress a little bit more sticky. So in terms of charts I want to highlight, well, the first is back to the 10-year gilt yield. We had the jobs data on Friday. That jobs data in itself was seen as a little bit disappointing. It missed on the headline numbers, and the unemployment rate remains resolute at 7.4% at the moment, still some way from the 6.5% that has been the initial target of the Fed at the moment. Question marks being sort of asked as to how effective QE can be towards achieving its goal for the unemployment rate, and but September still being considered as the expected date for any tapering or reduction in the level of QE from the current $85 billion per month. Yields on 10 years did push towards 2.75% on the back of strong data last week, but that jobs report meant that the yields have reined back in a little bit, back to around 2.6% at the moment, but still at those elevated levels at the moment. In terms of the UK, we mentioned about strong construction data, certainly strong PMI data for the services sector this morning. It has been good enough to see quite a strong rebound in the value of sterling, and we're back up towards that sort of 153, so standing well clear of the sub 150 level that was achieved during the early part of July, and as that trend shows, sort of move back up towards the sort of 156 level may well be on the cards for the UK, given the momentum that we see behind the economy at the moment. Wednesday's quarterly inflation report being obviously the key event for currency, or the sterling currency, this week. In terms of indexes, well, I wanted to highlight the chart of the FTSE 250, which broke cleanly through the top end of the range, and cleanly through 15,000 as a target. So the index is now up 22% year to date. The index avoids mainly some of those utility and financial stocks, but as a result of that, utilities held back the FTSE 100, we suspect, during the first half of the year, but the underlying tone of markets here proving to be very strong, and stocks that are clearly delivering on good results at the moment continue to surge higher at the moment. So real interest in the mid and small cap sector. The S&P, a very similar chart there, pushing through to 1700 last week, and holding well above those levels, and again reflecting on what appears to be some fairly confident Q2 numbers. Just in terms of moving to some stock features from last week, those particularly that we cover, the disappointing one for us last week was Sanofi. Those numbers, in that this is a $100 billion healthcare group, and certainly one of the major players in the healthcare market throughout the global markets. Disappointed, their numbers came in shy of expectations last year. We see that as a buying opportunity, and again we have updated our thoughts and the rationale behind the earnings miss, and why we still think that's a buy. So again, with your broker, it will be a research note should you want to have a look at that opportunity. In terms of the sector that was really the main mover last week, it was all about the banks, and Lloyds was the star feature. It's a company that over the weekend was talking to the Financial Times about a potential 70% payout ratio for its dividends. This is obviously in the sort of up and coming 14-15 2016 year. That level of dividend payout reflects the fact that it is a well capitalised bank at the moment, that has a big market share in the UK at the moment, and things have been very much on the turn. They have taken costs out of the business, profits are running ahead of expectations at the moment. Will the government start selling its stake this week? Well, it looks like if they were, we'd hear more noise about it. I suspect they're going to push that back more to September, when markets tend to become a little bit more liquid and volumes tend to rise during September. And I suspect that that's when they'll do that. But the price this morning is one of the top movers on the day, up to around 76-77 pence, so standing well clear of the 61 pence, which is deemed to be the break-even point for the government. Disappointment last week was Shell. Shell shares fell by around 5%. It was quite a big miss at the top line for Shell last week. They've got problems in Nigeria. There were some currency translation issues which obviously impacted on the PBT line, which should work itself out. But quite a big move to the downside for Shell, and again that is another stock where we're using that opportunity to recommend buying shares in Shell at this stage. Again, an updated note is available from your broker. A couple of the stocks that I wanted to mention was just the continued strength within the airline sector. IAG, or the International Airline Consolidated Group, which represents British Airways and Iberia, shares up around 70% year to date, and we saw some very big upgrades in that stock on the back of its results last week. I've seen 20, maybe even 30% upgrades to earnings per share, and that is carrying through for the next 2 to 3 years. And on the revised numbers, it could be argued that this stock is still looking very cheap, even though globally it has been the second best airline performing stock. But as you can see from that chart, still some insatiable appetite for acquiring stocks in the airline sector. British Airways, as I say, being one, EasyJet also hitting new highs last week. And finally, it's just a really chart to reflect that tomorrow it is that Intercontinental Hotels Group, one of our covered stocks. We'll be taking a look at their results, and in terms of how the hotel industry, particularly globally, particularly in China and Asia, how that market is performing at the moment. We suspect it's going to be strong, and as I say, we will have a note out during the course of this week on this stock.